All right, let's talk about something pretty wild. Imagine this. You're buying a house in today's market, right? But instead of getting a mortgage rate somewhere around 7%, you manage to snag one that's closer to 3%. Sounds like a fantasy, doesn't it? Well, for some people, this isn't a fantasy at all. It's a real strategy. The big question is, though, is it a golden ticket or is it a trap?
So this is the line. This is the sales pitch you're starting to hear from sellers who are, a little anxious in this slower housing market. They're not just selling you a house with a nice yard anymore. They're selling you their unbelievable mortgage rate that they locked in back in 2020 or 2021. And this is all possible because of a thing called a mortgage assumption.
And there it is, the million-dollar question. Because let's be honest, if it sounds way too good to be true, it usually is. This deal, which looks so perfect on the surface, has some really big hidden problems that can turn what seems like a dream into a total logistical nightmare.
I mean, look at this. The reason this is even a conversation is because the incentive is just so huge. We're not talking about saving a little bit here and there. The difference between a 7% rate and a 3% rate, that can mean hundreds, maybe even $1,000 a month back in your pocket. That is the financial carrot that makes people willing to jump through some pretty serious hoops to make this happen.
So what are we even talking about here? Well, a mortgage assumption it's pretty much exactly what it sounds like. You, the buyer, literally take over the seller's loan. You get their remaining balance, their payment plan, and the most important part, their ridiculously low interest rate. It's almost like finding a financial time capsule. Now, the key thing to know is that this doesn't work for just any old mortgage. It's usually only an option for government-backed loans, like FHA, VA, and USDA loans.
So, what's the first major hurdle you're going to face? Well, before you even get to the complicated money part, you have to deal with time. And in the world of mortgage assumptions, time moves very, very slowly.
Getting an assumption approved by a lender is, to put it lightly, a total slog. It is nothing like getting a new mortgage, which might take, 30 to 45 days? Nope. Here we are talking about 4 to 6 months on average. And it's not crazy for it to drag out for 8 months, or sometimes even longer. That is an incredibly long time for a deal to just be hanging in limbo.
And that long wait is just plain dangerous for the deal. I mean, think about it. Over all those months, just about anything can happen. The seller could get a much better all-cash offer that can close in 2 weeks. You, the buyer, might get fed up and find another house you love. The entire housing market could shift. It just introduces this massive amount of uncertainty, where the whole thing could fall apart at any moment.
But you know what? That timeline, it isn't even the biggest problem. Not by a long shot. The number one most complicated obstacle is what's known as the financing gap. This is where the math gets really tricky, and it's where a lot of these deals just hit a brick wall.
Okay, let's just walk through a super simple example to make this crystal clear. Let's say you found the perfect house and you and the seller agree on a sale price of $500,000. So far, so good.
Okay, so the seller, who was smart enough to get their loan a few years back, still owes $150,000 on it. This right here is the part of the loan you're going to assume. This is the piece with that amazing 3% interest rate. This is the price. And for our example, let's say you're planning to put down 5%. On a $500,000 house, that's $25,000. That's the cash you're bringing to the table. So, where does that leave us?
And boom, this is where the problem smacks you in the face. You start with the $500,000 price. You subtract the $150,000 mortgage that you're taking over, you subtract your $25,000 down payment, and you're left with this massive $325,000 hole. That's the money you still have to find to pay the seller for all of their equity in the home. And here's the real kicker. You now need a second loan to cover that huge gap. The problem is, any bank that gives you that second loan has to agree to be in what's called second position. All that means is that if you stop paying and the house gets foreclosed on, the original lender gets paid back first. Your new lender, they only get paid with whatever money is left over, if there's any left at all. This makes it a way riskier loan for them, and honestly, most banks just say, no thanks, and won't do it.
So, if this whole thing is such a mess, why is everybody suddenly talking about it? I mean, mortgage assumptions have been around forever, at least for these kinds of loans. But for years, they were basically just an obscure footnote in the real estate world. That has all changed. This chart right here, this explains everything. Back in the day, if a seller had, say, a 4.25% rate and the going market rate was 4.75%, nobody was going to go through an 8-month-long process and a financing puzzle just to save 0.5%. It just wasn't worth the hassle.
But today, when the seller's rate is 3% and the market rate is 7%, that enormous gap makes the potential payoff big enough to actually justify the headache. And that's what's brought this whole idea roaring back to life.
So let's wrap this all up. After looking at the ridiculous wait times and the massive financing gaps, what's the verdict here? Is a mortgage assumption a brilliant life hack, or is it just a dangerous trap waiting to spring?
You know, it really just boils down to a simple trade-off. The pro is singular, but it is massive. You get an interest rate that is basically a historical artifact. It'll save you a fortune. But the cons are serious. The process is painfully long. The financing is a huge puzzle. And the risk of the whole thing just imploding after you've waited for months is very real.
And that really just leaves us with the final question. There's no one-size-fits-all answer here. It all depends on your money, your patience, and really, your stomach for risk. For the perfect buyer paired with the perfect seller, hey, it could be the deal of a lifetime. But for almost everyone else, it might just be a complicated nightmare that's not worth the trouble. So, you really have to ask yourself, is that amazing rate truly worth it?